Hey everybody, welcome back to Young Bucks. Greg Moyer here. This week we have a unique episode. Myself and Chris Annunzio are making our first appearance on Young Bucks. Chris and I make up the social media team here at Tusk, and we had a discussion with Ben Nye on how he ranks the top 5 heartbreaking stocks of 2017. We also have Sam Frost and Matt Krebsbach diving into the Broadcom, Qualcomm, NXP saga with some predictions on how that acquisition triangle will play out. And finally, we're wrapping up this week's episode with an exclusive sneak peek and an interview we did for the Investing Podcast. Ben Nye interviewed Greg Silberman of ACG Wealth. That will be a long-form interview on emerging markets, and that will be released tomorrow, which is Friday, over on the Investing Podcast. So be sure to subscribe to the Investing Podcast as well, so you can catch that interview tomorrow. Enjoy the show. Hey, how's it going, everybody? Today I'm joined with Chris Annunzio. Also, we got Ben Nye, a familiar face. Chris and I making our first appearance here on Young Bucks. We'll see if we can do all right. So today we're going to do a top 5 countdown of the heartbreaking stocks from last year. So we got a lot to cover, and Ben's going to kind of be our analyst on this. Chris and I are going to ask the dumb questions. We're good at that. So let's start off with number 5, which is Mattel. So, Ben, what do you think? We've seen Mattel kind of decline pretty steadily. Is this the end of toys? I mean, we see, obviously, there's a lot of app-based games. That's kind of where the market is. If you think about games now, you think about smartphone games and stuff like that, or online streaming games. So what do you think? Is this the end of toys? Is this it for Mattel?
You know, it's a great question. I mean, and obviously the stock has told us something over the last number of years, and especially last year when it was one of the worst performers in the S&P 500. What I think Mattel's just become a victim of is exactly what you're saying. People are buying fewer dolls, fewer action figures, and especially last year they had a really tough comp because the year before they were still selling a lot of Frozen merchandise. They were selling a lot of Star Wars merchandise from The Force Awakens, and that didn't really happen so much last year. Yeah, they sold a few BB-8 things, but you know, Mattel is just kind of a relic. It's a bit of a dinosaur, and kids aren't excited by that anymore. It's a lot of whimsical products for adults, but as far as the kids, you know, they're playing Pokemon Go. They're not actually buying the Pokemon figures themselves.
Which is wild because you think that's what we would think. You think Mattel, you think Hasbro, Milton Brat. I mean, all those, that's kind of synonymous with me growing up, so it's kind of strange to think, might be the end of the road.
It's a sad time. It's a sad time.
So before we started this segment, you kind of ran me through what master limited partnerships were, Ben. And ultimately, one question that stood out in my mind is because oil did great last year, why do you think MLPs fell behind a bit?
Yeah, so another heartbreaking story. You know, I think a lot of people wanted to buy the master limited partnership. So just kind of taking a step back, master limited partnership is essentially a partnership in a infrastructure asset. So in this case, many infrastructure assets are pipelines. So just think of, for the purposes of this podcast and the scope of what we're about to go into, we'll just think of it as a pipeline. So you're pushing oil through a pipeline. You think, okay, well, oil prices go up. Master limited partnerships should do well because they're shoveling more oil through the pipe. Problem with that is that one of the reasons the oil price goes up is because people stop producing as much. Some of that production shuts down, which happens when oil goes really low, like it did a couple years ago. So what had happened was, number one, oil price goes down. Number two, a lot of this production gets shut down. Number three, oil price actually starts to go up because now you have less supply. And then, only then after that, do oil companies start producing more, and then that flows through to the MLPs. So MLPs were a nice way, kind of a chicken way to play the whole energy rebound. Unfortunately, they just didn't perform the way one would have hoped last year. Yeah, they threw off nice dividends, but they didn't get that share price appreciation that I think a lot of investors would have hoped for, with oil price going from $45 to $65.
Gotcha. So moving right along, that was number 4. Now we're on to number 3, which is Wells Fargo. So I know we had over the last year, I know back in August that the number of fake accounts with that whole scandal even jumped up again. And I think it was like 3.5 million was maybe the end number that they said, fake credit cards and bank accounts. And then also we had automatic bill pay that customers were enrolled in without their knowledge. And obviously there's settlements on top of settlements going out and money being refunded to customers. So do you think that is the reason why we see that slump? Do you think there are other factors there? What was the core of Wells Fargo's heartbreaking trend last year?
Yeah, well, again, kind of another bit of nostalgia here, because I don't think there are very many people who are fans of the big banks. But
no, I love the big banks. I love every single one of them.
There is a sympathy that, you know, the guys who actually made it through the crisis and didn't blow up the economy like a Wells Fargo are, you know, they're looked on, you know, maybe they're not quite as bad as some of the other guys, like the Countrywides of the world. Having said that, now you have this reality check. Like, yeah, you know, they're making up fake accounts. They're kind of as bad as the other guy. The thing about Wells Fargo is that they had these issues in the fall of 2016. And it just kind of continued. There was never one cockroach. It just kept coming. And Sam Frost, another analyst, likes to say that all the time. There's just never one cockroach, and that's exactly what we saw happen at Wells Fargo. So I think they're now trying to do the right things. Full disclosure, we are long Wells Fargo. We're also long a few MLPs, and we can include that in disclosure at the end. But I think now they might be able to turn the corner, but they need some change at the board level because the oversight is just not there right now.
Yeah, I remember it was Senator Elizabeth Warren when she was calling for anybody on the board that was there during that scandal.
They want
get rid of all of them.
They want heads to roll.
They do, yeah. I guess we'll see what happens there.
All right, so moving on to General Electric. So number 2, basically what we have is they've been on a steady decline for the past year, going from about $30.28 a share to now just below $15. Do you think that there's any way for them to get this turned around? I mean, especially now that they have a accounting scandal going on.
Yeah, no, that's a great question, because, you know, again, another heartbreak. I mean, I think you talk to any of our dads about, okay, what are your 5 favorite stocks where you would never lose money in? And they would say like IBM, probably Bank of America, and maybe Disney, and then probably General Electric as well. Yep. They just, you know, it's just something that could never blow up. It's just a quintessential American company started by Thomas Edison in the late 1800s. How is this possibly going to go bad? And, you know, what happens? You get a bad actor involved. He didn't have one jet. He had 2 private jets, the one that flew behind the other one.
Right.
Top of the line. And, you know, that when you manipulate accounting books, which is what he did, you have these hard resets, and this is what GE is going through right now. And there's, again, kind of what we were talking about with Wells Fargo. There's never really just one final event where you say, okay, all the bad news is out. It's like just the constant flow of negative news saying, you know, maybe that now this is a problem. Now the power unit's a problem. Now they're having a problem in the oil and gas, and now the airplane. It's just one thing after another. And it's a shame to see such a great American company like GE succumb to the problems of even the lowliest foreign company.
Right. That's same here. That's one of those things that you'd think, yeah, GE never going anywhere. Anyways, so Snapchat is our number 1 heartbreaker. So Snapchat, I've heard Snapchat a lot around this place over the last couple months and maybe longer than that. So obviously last year we saw that stock go down. So recently with the quarter 4 earnings, I think they beat estimates on quarterly sales, and even daily active users were up. I think they had maybe close to 9 million new users sign up in the last 3 months of 2017. So we've seen that stock spike a little bit here recently. I mean, do you think this is new life for Snapchat, or do you think it's over?
Man, it's bad that I have to disclose that we own every single one of these companies, but we do own some Snapchat. We do own some General Electric.
Right.
No, but so with Snapchat, I think they came public just too early.
Yeah.
They came to the public markets too early. They were an immature company. I actually think that their management is a little bit further along than where Facebook's management was, for instance, when they came public. But the business wasn't mature. They hadn't really ironed out what the business is going to look like. And it really just felt like an app, and they came public and they were showing great growth, but there was a limited sample size. And as more samples have come to market, the markets started to realize, hey, this is a far more volatile situation than perhaps they would have liked at the beginning. When Snapchat first came public, there were many analysts on Wall Street saying, hey, this is a buy, this $30 price target, $35 price target. And then about 3 months later, all those buys started to go away, and then the price target started to come down, and now it's tough to find a bullish analyst on the street on Snapchat. It'll be interesting to see what 2018 holds for them. They think they may have turned a corner. They just came out with this redesign, which I'd be interested to hear about your thoughts on the redesign. They're doing well with 35-year-olds and up, but as one of the people around the office said, that's probably a reason not to like it, because it's probably a reason the people under the age of 35 don't like it.
Well, it's also not their target market. I mean, 35-year-olds, when you hear Snapchat, I think people our age are the ones using it the most. And so I think this new update kind of does cater to an older population, but it's just not their target market.
Which is kind of funny to me, too, because I think you ask a layman about Snapchat that doesn't really know much about the way the market works. I'll say that I'm one of those. And you could pull, a straw poll of a lot of people that would use Snapchat. They'd be, oh, yeah, I bet that stock's great. I mean, how could it not be? Everybody uses it. But it's funny how those stories can be really different.
Yeah, so Snapchat, number one heartbreaker, I guess.
Yeah. Broke our hearts. All right, so that was it. The top 5 heartbreaking stocks from last year. Thanks to Chris. Thanks to Ben. Chris and I think we did okay for our first appearance. We tried our best. They'll never ask us to do it again. So,
right.
And thanks for joining us.
Hey everybody, welcome back. I am Sam. Joined here with me is Matthew.
Yeah. Hey, how's it going?
It's going good. Thanks for joining me.
Yeah, no problem.
So we're here to talk about Qualcomm. Quite an interesting story. You got a little tango going on between Qualcomm, NXP Semiconductors, ticker NXPI, and the third one is Broadcom. And so Craig's going to give us a little bit of the details on what's going on, but just a general high-level view. Qualcomm offered up to buy NXPI at $110 a share.
Yep, this was late 2016, I want to say. So this has been, it's not closed yet, and it's been in the process for a really long time.
Right. And so that's been working on it. Qualcomm's waiting for shareholders to tender up their shares and say that they want to go through and stuff, and it's just been dragging out. And then all of a sudden, Broadcom comes in, and they offer a bid to Qualcomm, an unsolicited bid to Qualcomm. Qualcomm turns it down, and Broadcom initially said, whether you want to buy NXPI, yes or no, we still want to buy you. Here's our bid. Qualcomm turns it down, and then Broadcom comes back in and says, all right, now it's a hostile takeover, and we're gonna take you out, and we're gonna try to force your board members, Qualcomm's board members out, put NXPI's board members in so that they can approve this vote. So really a bunch of stuff going on, a bunch of implications for share prices for these three companies, given who gets bought, who doesn't get bought, and what happens. So Krebs, gut reaction, what's going to happen?
My gut reaction is that the Qualcomm management team is going to do anything they can to keep their jobs. I'm a cynic in that way.
Yeah.
So I think they're going to turn down the Broadcom bid. They just had a meeting with Broadcom management yesterday, actually, to kind of discuss the terms of the deal. The current offer is $82 a share for Qualcomm. And then Qualcomm right now is trading at 64. So I think it's about a 30% upside from that deal price. And you say that's really substantial.
Right.
And it is. But I think that would be an enormous takeover. I think that offer would be $120 billion.
Wow.
It's just crazy to think about. So, I mean, there's probably a ton of antitrust issues there that Qualcomm is concerned with, and rightfully so. I would be too. But I think what's going to happen is Qualcomm is going to do whatever they can to close NXPI. Like you said, the deal there is trading at NXPI is trading at 110, or NXPI is trading at 116, and the deal price is 110. So that means the market's probably inferring that NXPI is worth more than that, and Qualcomm's going to have to offer more to close that. And I think that is the case. And Qualcomm's going to have to do that to make that company stronger. Qualcomm will be a lot stronger with NXPI, I believe. And in that scenario, I think they can kind of, push Broadcom back and say, no, we got this. We're going to grow by ourselves. Our projects are better without you.
So you would argue,
but Qualcomm's going to have to pay up much more than 110.
Right.
In my opinion, it's going to be 125 or so.
And so you would argue for Qualcomm's management to maximize shareholder value, that would be turn down the Broadcom offer or prevent that hostile takeover and pay up a little bit extra for NXPI to close that deal.
I think so, yeah.
Yeah.
I just think like Qualcomm management is right in saying that the antitrust stuff is going to take a long time. That's like we said at the beginning of this, the NXP offer has taken about, 18 months now?
Yeah.
And it's not even closed yet.
Right.
They're just waiting on the approval from China, which they'll probably get really soon. But still, that's taken however many months. That's going to take at least that much for Qualcomm, you would assume, just because it's an even bigger deal.
Right.
Broadcom has proposed offering a huge breakup fee, rumored to be the largest ever. This isn't finalized, but it's rumored to be the largest ever at $10 billion, which is enormous. Like it's crazy how big that is to try and, make Qualcomm management kind of more open to it. But even so, it's.
So there's a vote coming up, I believe March 16th.
Yeah, the Qualcomm board member vote annual meeting. Yeah.
Right. And so that's going to be a huge deal because if Broadcom can get their board members in on Qualcomm's board, then NXPI is no longer getting bought and Qualcomm will be bought by Broadcom. So in that scenario, would you say NXPI's share price goes up or down?
I think the knee-jerk reaction would be down. But I think over time it would go up higher. I think standalone XPI is a very strong company. I mean, they're really big in the auto space. I think, who's that company that Intel bought?
Mobileye.
Mobileye, like same type of thing. Just a really strong company. They've pumped out great results in this like interim period. They've paid off debt. Like it's a much stronger company than it was a year and a half ago.
Yeah, and so something we've talked about is we actually hold NXPI.
Yeah, we were holding that before that deal even came out because we like the company.
So before the deal ever came out, we were holding NXPI. We liked the company. Then Qualcomm comes out with this bid, and so NXPI trades straight up to the bid price, which was 110, and then they passed it because the rumor was that the deal won't close unless Qualcomm pays up for a higher price. And so the question is, if now NXPI is not getting bought, where does their share price go? And I'm also with you that I think their share price will go higher. Again, this started in 2016. There's been a ton of share appreciation in the stock market since then.
Especially in the semiconductor space. I mean, if you go back and look at any comp, even similar to NXP, you're saying, oh, this is worth at least 130 a share, and it's trading at 116 right now. Right.
And I think that NXPI, even though they've traded above the offer price, I think that there's been this ceiling that they can't bust through because right now the assumption is that they're going to be bought out at 110, maybe 120. So they've missed out on all the gains from 2017. And so I'm with you. We looked at evaluation earlier. I think NXPI is probably worth by itself around 130. So that's kind of an interesting play where you lose money is if they end up closing the deal at the 110 price.
I would be very surprised if that happened. And another thing I'll just throw in here, there's been a ton of like activist managers, fund managers that have gotten involved in NXP. Elliott Management being the biggest one. I think they hold about 8% of NXP shareholders, 8 shares outstanding now. And they've been very strong advocates that they won't accept the tender offer at anything lower than like 125 or 130. And they're talking to like all these other funds trying to get them on board too. So I would be very shocked if it went through at 110.
So final question: Qualcomm, they don't get bought out by Broadcom. What is their share price reaction?
I would assume down, just wouldn't you? I mean,
Yeah.
just without having that support of an offer on the table that usually happens.
Yeah.
Not that Qualcomm, not that it's deserved. As I don't think it's deserved, but
Right.
I think that's how it would happen.
And so Matt has been saying since we've held Qualcomm throughout this entire process, I believe, and Matt has been an advocate saying that they're worth like, what, $80, $78 roughly?
I think at least 70. Yeah.
Standalone. That doesn't include the synergies that would be captured with NXPI. But the catalyst that really bumped Qualcomm up from trading in the low 50 range to trading in the low to mid 60 range was when Broadcom came out with this offer.
The initial offer, yeah.
The initial offer. And so I also agree. I think Qualcomm immediately trades down if if NXPI can't put board members on Qualcomm's board come vote March 16th.
That's all speculation. I mean, who knows how the market's going to react.
Right.
And I think if and when Qualcomm did close NXP, as long as it's not at some absurd share price like 150 for NXP,
Right.
I think that would be beneficial to Qualcomm shares as well.
Right. So I think the initial reaction, Qualcomm drops, but that could be a buy opportunity for Qualcomm.
Potentially, yeah.
So there you have it. Now you know the three-way tango going on. Hope you'll join us for the next portion of our show.
Thanks, Sam. And now to wrap up the show, as promised, we have a quick sneak peek of the interview we did with Greg Silberman of ACG Wealth. That interview will be released tomorrow on the Investing Podcast. We'll leave a link in the description, so make sure you go subscribe to the Investing Podcast to hear the full interview with Greg Silberman, which will be released tomorrow, which is Friday. Thanks again for joining us, and here's Ben Nye with Greg Silberman. Thanks.
Today we wanted to talk about specifically emerging markets, and we'll get to some other topics as they arise. But emerging markets has been a phenomenal opportunity set for many, many years, reaching, excitement, euphoria back in the 2000s with the growth in Brazil, the growth in the BRICS countries in general. But over the past few years, really until last year, they had been a sort of source of frustration. So what is the attraction of these, of the theme in emerging markets that you really see?
Yeah, well, let me start off by saying that, and I've heard this said many times before about emerging markets, but they're not a homogenous market, so to speak. I mean, there is, I'm not even sure how many countries make up emerging markets, but it's going to be over 100 countries, all with their unique fundamentals and factors and whatnot. For the longest time, emerging markets used to be considered predominantly commodity-producing countries. In other words, less developed countries, naturally endowed in natural resources, but not very developed as far as consumer-driven economies, consumer credit and the like. So for the longest time, they were painted with a broad brush of if commodities do well, generally emerging markets do well. And a funny thing kind of happened this go-round, and let's say that I noticed it from about 2012, 13, 14 perhaps. If you follow some of the larger emerging market ETFs, EEM as an example, you notice that it diverged quite substantially from the awful bear market we were having in commodities. And that really, by no surprise, was driven by technology, the explosion of technology companies such as Tencent, Baidu, and Alibaba in the emerging markets, which has really taken a different spin on EM. And I'm sure Ben will get into that a little bit further. But emerging markets are seriously bifurcated now. And the other interesting aspect from a technology perspective is a lot of EM countries can really leap ahead of some of the developed world because they don't have to create the infrastructure that we spent most of the 60s, 70s, 80s, and 1990s, and even the 2000s building. They really can leap forward and assume the most current technology and really kind of get a head up on their own economies.
So in other words, they don't have to use the technology that we now view as old. They can just adopt the technology that exists in the world today and kind of go straight to where we are without having to go through the process of building over a series of decades.
That's exactly right. So I'm not sure when last you were outside of the country, but if you went to not any, but go to South Africa, go to the international airport in Johannesburg. It's a modern, immaculate airport. You go to the Singapore airport. Now Singapore is debatable whether it's an emerging market anymore, but really, first world type infrastructure compared to literally some of the airports that I've been to here in the United States. In addition, I would say that we're quite involved with some.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.